Day trading, the practice of buying and selling financial instruments within the same trading day, can be an exhilarating and profitable venture. However, it's a double-edged sword. The potential for high returns is matched by an equally high risk of losses. Even seasoned traders can fall prey to common mistakes that can derail their strategies and lead to significant financial setbacks. Here, we explore 10 common mistakes people make when day trading and how to avoid them. Day trading is not a casual endeavor. It requires a thorough understanding of the markets, trading strategies, and the specific instruments you're trading. Without proper preparation, traders are more likely to make uninformed decisions that lead to losses. Solution: educate yourself thoroughly about the market, trading strategies, and financial instruments. Develop a comprehensive trading plan that includes your goals, risk tolerance, and entry and exit strategies. Overtrading occurs when traders make too many trades in a short period, often driven by the excitement of the market or the desire to recover losses quickly. This behavior can lead to high transaction costs and increased exposure to risk. Solution: stick to your trading plan and only make trades that align with your strategy. Quality over quantity is key in day trading. Risk management is crucial to protect your capital. Without it, traders risk losing substantial amounts of money on a single trade. Setting stop-loss orders and determining the amount of capital to risk per trade are essential components of risk management. Solution: implement strict risk management rules. Use stop-loss orders to limit potential losses and never risk more than a small percentage of your trading capital on any single trade. Emotions such as fear, greed, and hope can cloud judgment and lead to irrational trading decisions. For example, holding onto a losing position in the hope that it will turn around can exacerbate losses. The solution? Develop a disciplined approach to trading. Stick to your trading plan and rules and avoid making decisions based on emotions. Consider using a trading journal to track your performance and identify emotional triggers. Many traders make the mistake of chasing the market by entering trades based on recent price movements without proper analysis. This reactive approach often leads to buying at high prices and selling at low prices. The solution is to focus on analysis and strategy rather than reacting to market movements. Wait for confirmed signals before entering a trade and avoid jumping in based on fear of missing out, or FOMO. Day trading requires patience and the ability to wait for the right opportunities. Impatient traders may enter trades prematurely or close positions too early, missing out on potential profits. The solution is to practice patience and discipline. Wait for the right setups and signals according to your trading strategy. Remember, it's better to miss an opportunity than to enter a trade without proper analysis. Both technical and fundamental analysis are essential for making informed trading decisions. Technical analysis helps identify trends and trading signals, while fundamental analysis provides insights into the underlying factors driving market movements. Solution: use technical analysis to identify trends, support and resistance levels, and trading signals. Complement this with fundamental analysis to understand the underlying factors driving market movements. Market news and economic events can have a significant impact on price movements. Traders who fail to stay informed about relevant news and events risk being blindsided by sudden market shifts. So, the solution is to stay updated with financial news, economic reports, and corporate announcements. Use a reliable news source and consider setting up alerts for important events that may affect your trading instruments. Some traders enter the market without a clear strategy, relying on intuition or tips from others. This lack of a structured approach often leads to inconsistent and unprofitable trades. The solution here is to develop a well-defined trading strategy that includes entry and exit criteria, risk management rules, and profit targets. Test your strategy using historical data and refine it based on your performance. Mistakes are inevitable in day trading, but failing to learn from them can hinder your progress and lead to repeated errors. Many traders ignore their mistakes or blame external factors, missing valuable learning opportunities. The solution is to embrace your mistakes as learning opportunities. Analyze your trades, identify what went wrong, and make adjustments to your strategy. Consider keeping a trading journal to track your trades and evaluate your performance regularly. By avoiding these common mistakes and adopting a disciplined, well-informed approach to day trading, you can increase your chances of success and achieve your financial goals. Remember, day trading is a marathon, not a sprint. Continuous learning, practice, and self-discipline are key to becoming a successful day trader.